Hello everyone. In this session, I'm going to talk about an article for FRM Part 2, wherein we are discussing the various current issues for 2017. As a part of the curriculum, this is one of the articles. And out of this article, there are a few aim statements that GARP has provided in the learning objectives. So, I'm covering primarily those aspects which are asked as a part of the aim statement from that particular article. So if you really want to read the full article, I suggest you download the article from GARP, and based on that you get an end-to-end understanding of that particular article. So as a part of this session, I'm talking about what are the key risks that are associated with algorithmic trading, including the high frequency trading. We will talk about four different aspects of risk here, which are very much exclusive to algorithmic trading. And how do we really monitor and control the various risks that are associated with algorithmic trading? So we'll talk about a few of those procedures. To what extent the algorithmic trading activity is incorporated in the overall risk management frameworks. So what is the process or the procedure to incorporate the algorithmic trading activity in the overall risk management framework of the company? What are the various tools to monitor the risks that are associated with the algorithmic trading? So these are the four major areas I'm going to take up here. Now, looking at the key risks which are specific to algorithmic trading or which are very much possible with algorithmic trading. One, I can see the systemic risk can be amplified. The overall financial system getting badly impacted. Algorithmic trading can influence the systemic risk quite heavily. Look at a scenario, a small algorithmic trading firm. Let's say in one of the algorithms that it has designed, there is an error. A very simple example. Right, we are talking about a very small algorithmic trading firm where one of the algorithms that it has designed has an error in it. Now, there is a very good possibility that that particular error can cascade through the market, because the trade that it has placed with that error could impact the price differently, and because of that price all the other trades get badly impacted. So that simple error is cascading through the entire market. The whole financial markets can get badly impacted, either because they will also commit errors because of the changed price, even their algorithms will go erroneous, or how this particular algorithm reacts to the error of that one single erroneous algorithm is a very tricky part out here. So overall we could see that because of these cascading impacts, the overall systemic risk can very well be amplified through algorithmic trading. And not only the individual traders, in some cases we could see that the clearing houses and the central counterparties also may be very badly impacted. But of course, compared to the other trading firms, the central counterparties may not be that heavily impacted because of the errors of algorithmic trading. But still, they depending on the volume of the trade, depending on the level of dependency of that particular algorithm with respect to others, even their profitability could be very much impacted. So overall we could see that the algorithmic trading can very well amplify the systemic risk. Then intraday is one major risks which algorithmic trading desk can very well face, because in case if they don't have transparency and robust controls. And what we really observe is in the real world also, they might have a very good process in place or controls in place for handling out the risk across the day. But intraday, what we typically see is many trading firms, the intraday based risk controls are not that robust compared to for a day trading. Whatever are the controls that are kept for a day trading are completely different from the trade controls that they have for intraday. We generally observe many weak controls existing for intraday. So the reporting of the losses regarding the intraday may not be complete. They may not have a proper process in place for intraday reporting. So the timely reporting of the losses and risks intraday is also a lagging process. Limit breaches within the day, again there might be a problem. So these things, the way they are governed, the way they are controlled, the way the information is provided to the senior risk officers, the transparency is much lesser in an intraday basis compared to a day-wise basis, and that itself could impact the overall the overall profitability of various algorithmic trading desks. So there is the possibility of unintended accumulation of a large position during a trading day. Without knowing, a huge position would have got accumulated during the trading day because of the algorithm, and which means before the end of the day there is a very significant exposure that is being taken up by the firm because of large amount of unintended accumulated position during the trading day. So even that is that's one of the significant risks that the algorithmic trading firms will typically face. Sometimes the other operational aspects like technology failure, market conditions hugely swinging away, going away from the intended movements, exceptional movements, unanticipated movements, an algorithm failing very badly, which means big significant amount of risks are taken up by these algorithmic trading firms. So these are some of the risks which are exclusive to the algorithmic trading activity itself. Similarly, the internal controls, which are very weak on an intraday basis. Along with that, in general, the internal controls, they have not kept pace with the speed. Algorithmic trading happens at such a speed. So I want the controls also to go more or less in parallel with the speed of execution of the algorithm, even with respect to market complexity as well. So the various malfunctions that are happening at various financial institutions, they can really amplify the overall impact. At the same time, look at the control. Many banks which are having the prime brokerage business with the various small algorithmic trading firms and various high frequency trading firms, they are the clients of the majority of the banks. The prime brokerage business is coming from these clients. And I don't know how these guys are having the risk controls at their platforms. So which means monitoring the risk controls across all these businesses, it varies widely, and that itself could be an additional potential risk. And if the controls are not adequate, we know that the loss can have a ripple effect. It can very quickly cascade through the entire financial system. So we have seen a scenario in 2010 when there was a flash crash. One big execution algorithm working in an unexpected way, we have seen that the market has crashed quite drastically in 2010. The same way when Facebook has gone for an IPO in 2012, There was a big system related problem at the exchange, which has again resulted in a big impact on the markets. Similarly, the 2012 night capital incident, where the malfunctioning of an order routing system was clearly understood. So we see that even today there are quite a good number of risks that are associated with the algorithmic trading, which needs to be understood, which needs to be appreciated, and for which the governance and the controls need to be appropriately in place. Coming to the monitoring and the controlling of the risk, the control should keep pace with the technology speed. There should be a speed. They should keep pace with the technological complexity as well as the trading speed. What is the news if the control cannot detect some kind of error that is coming up because of faulty execution at a faster pace? So I require a multi-layered defense in-depth control, which means multiple controls should be there at multiple points in the process, not just a one-time validation activity. So this should clearly at different points in terms of the execution of the algorithm, right at the time of design of algorithm to the when I'm sending that algorithm to the system, when the results are coming out, there should be a multi-stage controls at multiple points in the process. That is where the control would be increased, the redundancy of the algorithm and the results could be decreased, and the diversity can occur. So the algorithmic trading controls should exist before the launching of the algorithm. I should have ample testing done at that particular process. Various controls need to be executed and evaluated. Any change that I am making to the algorithm, again there should be appropriate controls in place. During the entire trading life cycle, I should have controls in place. And even during the incident response, even when I'm getting the response from the process, there should be adequate controls in place. That is one thing which we expect if the algorithmic trading activity needs to be really successful. So we need to have controls not just at one single point, but it should cover all aspects of the trading process. Right from order generation, I should have appropriate controls in place. For order handling, appropriate controls should be there, and even for the execution of the orders, right set of controls need to be in place. So the controls should be in line with the complexity and the speed. Governance and the management oversight can limit the exposure to the losses. So there should be some kind of controls with respect to the limits that are put to the various exposures, and even the transparency process improvement can really set the algorithmic trading in a good direction. So whatever the controls that are being laid up, they should be aligned with the risk appetite framework of the firm, and it should be consistently applied across all the business units of the firm, not in an integrated or an enterprise-wide kind of an approach, not to be looked at in a siloed way. Coming to how the algorithmic trading activity needs to be fitted into the various risk management frameworks, we should understand that the various markets, the different market participants, clearing houses and other clearing entities, they should keep on reviewing their risk management policies at regular intervals, overall risk management as well as the operational risk management related policies and procedures, so that they are taking into consideration the best practices which are to the current, because this is something which is constantly changing. New innovations are coming up in this industry. So whatever the policies and the procedures are, they should be reflecting to the current practices, the best practices of the current scenario. They have to keep their resources and the various teams up to date, and this entire activity should be incorporated as a part of the overall risk management framework of the organization. So whosoever are involved in this process, they should be very clearly aware of all their responsibilities. There should be very clearly established procedures for coordinating with the various markets, market participants, and the clearing agencies so that they can respond very well to the various market incidents. And all the responses to various incidents, they should be taken in an integrated manner with the entire rules market wide, so that any event, any risk cropping up, it would be addressed in a timely and an effective manner. So the intention is the entire algorithmic trading activity should be completely incorporated into the risk management framework of the organizations. And regarding the tools, one, I look at it as a testing. Testing needs to be conducted during all phases of the trading life cycle, right from the development process to the rollout process to production and even the maintenance. Across all the phases, in-depth testing activity with various tools need to be conducted to ensure that the algorithmic trading process is error-free. To mitigate the risks that are associated with the algorithmic trading process. And also I need to really assess the depth of the controls, the suitability of all the controls relating to algorithmic trading. But when I am assessing those depth as well as suitability, I should make sure, or the firm should make sure, that people from all different control functions like compliance, I have people from compliance taking part in the assessment of the depth and suitability of the various controls. I should get representatives from the technology team, from the operations team, from the legal, controllers, market risk. I need representations from all the team, including the business unit managers, so that I can do a good job in assessing the depth of the suitability of the control, so that overall risk associated with the algorithmic trading can very well be mitigated. So these are some of the things that I wanted to talk about in this session. It's a very small article and the aim statements are only 4 in number. So I suggest that you read through the article. If you have any further queries, you can very well get back to me by giving me a call on the number that I have given below, or you can even send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.